All right. Japan's 10-year bond yield just hit 2.92%, its highest since 1996. And after 30 years of nobody wanting it, foreign money is flooding in at a record pace. But the same rising yields attracting all that money are crushing the most indebted government on earth, and a carry trade that crowded never exits calmly. Here's the full story and why every wire runs back to your retirement account and your mortgage.
So for 30 years, one of the largest financial assets on Earth was something almost nobody on the planet wanted to own. The 10-year Japanese government bond, the basic loan you make to the government of one of the largest economies in the world, paid so little interest for so long that owning it was treated as a kind of financial punishment. For decades, it sat near zero. At times, it even paid less than nothing, meaning you were charged for the privilege of lending Japan your money. Global investors avoided it the way you would avoid a bank account that quietly shrinks a little every single month, and now all at once that has flipped and the money is pouring back in. The 10-year Japanese government bond yield recently touched 2.92%, its highest level since 1996, a full 3 decades ago. Foreign investors are piling in with unusual speed. The funds that hold Japanese bonds have taken in a record $1.5 billion this year alone, nearly 3 times what they took in across all of last year. To feel how strange this reversal is, consider that an entire generation of Japanese investors has never earned a meaningful return on their own government's bonds in their working lives. A person who started a career in Japan in the mid-1990s spent their entire professional life in a world where the safest, most basic investment paid essentially nothing, where saving was punished, and the very concept of earning interest felt like a relic of the distant past. That world has now flipped in the space of a couple of years, and the same bond that paid nothing for 3 decades now pays nearly 3%, a change so fundamental that it rewrites the basic math of saving, investing, and borrowing for the entire nation. When something that has been true for 30 years reverses this fast, the adjustments ripple through every corner of the financial system, and not all of those adjustments are gentle. On the surface, this looks like wonderful news for Japan. After 30 years in the wilderness, the world finally wants its bonds again. But here's the twist that makes this one of the most dangerous financial stories on Earth right now. The twist almost nobody is explaining. The very same money that is rushing in to buy these bonds is the money that could blow the whole thing apart. And the very same rising yields that are attracting all this foreign cash are slowly strangling the government that has to pay them. Japan has become a trap that is baiting itself, drawing in the exact money most likely to detonate it. And the reason this matters to you thousands of miles away is that when this trap finally springs, the shockwave runs directly through the American stock market your retirement sits in and the interest rate on the home you're trying to buy. Come for the finance and stay for how a bond nobody wanted for 30 years suddenly became the most important and most dangerous asset in the world, and why the money now rushing toward it may be lighting the fuse on your own portfolio. To understand any of this, you first have to understand a single idea about bonds that most people have never had explained, and once you have it, the entire story snaps into focus. A government bond is a loan to a government. You hand over your money, the government promises to pay you a fixed amount of interest each year, and at the end it gives your money back. That fixed payment never changes for the life of the bond, but here's the part that trips everyone up. Once you own that bond, you can sell it to someone else, and its price moves up and down every day, and there is an inverse seesaw at the heart of it. When a bond's price falls, its yield rises. When its price rises, its yield falls. They always move in opposite directions. So when you hear that Japanese bond yields have surged to a 30-year high, translate that in your head to this: the price of those bonds has fallen hard, and the people who owned them before this all started have taken real losses. The yield going up is the same event as the price going down. They are two descriptions of one thing. Now, why have Japanese yields suddenly surged after 30 years near the floor? The answer is a story of an entire economic era ending. For 3 decades, Japan fought a slow sickness called deflation, where prices kept falling, people kept delaying purchases because things would be cheaper later, and the economy ground toward a standstill. To fight it, Japan's central bank pinned interest rates near zero and kept them there for a generation, longer than any major central bank in modern history. It even directly controlled the bond market, buying enormous quantities of its own government's bonds to force yields down and hold them there, a policy so extreme it was like a hand pressing permanently on a scale. That entire era is now ending. Inflation has finally returned to Japan, driven by a weak currency and rising import costs, and the central bank has been forced to let go of the scale, to step back and let yields rise towards something more normal. 30 years of suppressed artificial near-zero rates are unwinding, and the bond yield is climbing to levels an entire generation of investors has never seen in their careers. It is worth pausing on how total that suppression was, because it explains why the release is so dangerous. For years, Japan's central bank ran a policy called yield curve control, which meant it publicly committed to holding the bond yield below a chosen ceiling and stood ready to print unlimited amounts of money to buy any bonds necessary to enforce it. Think about how extraordinary that is. The central bank did not merely influence the price of money, it dictated it by decree, becoming the buyer of last resort for its own government's debt on a scale no other major nation has attempted. At the peak, the central bank came to own more than half of all outstanding Japanese government bonds, an almost unimaginable concentration, effectively swallowing its own bond market. Unwinding something that extreme is like slowly releasing a spring that has been compressed for 30 years. Nobody has ever done it at this scale before, which means nobody truly knows how violently the spring releases once it starts to move. And the market now widely expects the central bank to raise its policy rate again as soon as September, with its rate already at 1%, itself a 3-decade high, which would add yet more upward force to yields that are already climbing. For global investors, this is the part that suddenly makes Japanese bonds attractive. For 30 years, there was no reason to own them because they paid nothing. Now they pay almost 3%, and to a certain kind of large, cautious investor, a stable, wealthy, developed country like Japan, paying 3% on its bonds looks like a gift that has not been available in a generation. Strategists have started describing Japanese government bonds as moving from uninvestable to investable, saying that investors are finally getting paid to own Japanese paper again. And so the money has begun to flow, a record $1.5 billion into the funds that hold these bonds this year, nearly triple last year's pace. On its face, a rational response to a real opportunity. But now we arrive at the trap, and this is where the story turns from a simple opportunity into something far more precarious. Because the same rising yields that are attracting all this foreign money are simultaneously crushing the government that has to pay them. And to understand why, you have to grasp the almost unbelievable scale of Japan's debt. The Japanese government owes more than 204% of its entire annual economic output. For every dollar the Japanese economy produces in a year, the government owes more than $2. It is the most indebted major nation on the face of the earth, carrying a debt burden that dwarfs every other developed country, a mountain of borrowing built up across those same 30 years of trying to spend its way out of deflation. And that mountain is about to grow taller, which is part of what is spooking the bond market right now. Japan's new political leadership has leaned toward more government spending, not less, with ambitious plans that would require even more borrowing on top of the largest debt pile in the developed world. When investors see a heavily indebted government preparing to borrow even more, right as the central bank steps back from propping up the bond market, they demand higher yields to compensate for the growing risk, which is a large part of why yields have jumped in recent weeks. It is the collision of two forces at the worst possible moment, a government wanting to spend more just as the buyer that financed everything for 30 years is stepping away. The market is being asked to absorb a flood of new borrowing without the safety net that held it up for a generation, and it is repricing the risk accordingly. Now connect that mountain of debt to the rising yield and you see the trap close. When a government owes that much money, the interest rate it pays is not a minor detail. It is a matter of survival. Already around a quarter of Japan's entire national budget goes to nothing more than servicing its debt, paying the interest on what it has already borrowed. $1 in every 4 the government spends does not build a road, or pay a nurse, or fund a school because it goes to interest instead. And that is with yields having only recently begun to climb. Every further increase in the yield raises the cost of all the new borrowing Japan must constantly do to roll over its enormous debt, which means every basis point higher makes the fiscal position worse. The government is like a family already spending a quarter of its income on credit card interest, watching the rate on those cards climb higher month after month, knowing it has no choice but to keep borrowing. The rising yield that looks like an attractive opportunity to a foreign investor looks like a slowly tightening noose to the Japanese treasury. The same number read from two sides means opportunity to the buyer and strangulation to the borrower. This is the self-defeating heart of the whole situation. The higher yields go, the more attractive Japanese bonds look, so the more foreign money floods in. But the higher yields go, the more the Japanese government is crushed by its own debt costs, which raises the fear that Japan cannot afford its finances, which pushes yields even higher, which draws in even more yield-hungry money, which deepens the strain. It is a spiral that feeds on itself, and the foreign money rushing in is not calming it. It is riding it, and in riding it, potentially accelerating it toward the edge. And that brings us to the most dangerous feature of all. The one that turns a slow fiscal squeeze into a potential financial earthquake, which is the nature of the money coming in. A great deal of the foreign money that flows into a suddenly attractive market like this is not patient. Long-term money, it is fast money, hot money, the kind that chases yield wherever it appears and flees at the first sign of trouble. When a trade like this gets crowded, when everyone piles into the same bet at the same time because it looks like easy money, it creates a dangerous fragility because everyone is now standing on the same side of the boat. And history is brutally clear on what happens when a crowded trade like this unwinds, because the exit is never orderly. When the crowd all tries to sell at once, at the first sign the trade is turning, there are no buyers left. Prices collapse in a rush, and the same money that flooded in gently on the way up stampedes out violently on the way down. A crowded trade is calm right up until the instant it is chaos. Let me make the danger concrete, because the word crowded does not capture how the machinery actually breaks. Much of this fast money does not use only its own cash. It borrows to amplify its bets, a practice called leverage, where an investor puts up a small amount of their own money and borrows many times more to make a much larger wager, multiplying both the gains and the losses on the way up. Leverage is glorious, turning a modest yield into a spectacular return. But leverage has a vicious property on the way down. When the trade turns even slightly against a leveraged investor, they can be forced to sell immediately to cover their borrowings, whether they want to or not, in what is called a margin call. And here is the trap inside the trap. When one leveraged investor is forced to sell, it pushes the price down further, which forces the next leveraged investor to sell, which pushes the price down further still, in a cascade where each forced sale triggers the next. This is how a crowded, leveraged trade turns from a gentle drift into a violent avalanche in a matter of hours. It is not that everyone chooses to run for the exit at once, it is that the machinery of leverage forces them to, all together at the worst possible moment. The Japanese carry trade has exactly this structure, which is why its unwinding could be so much more violent than the calm inflows today would ever suggest. Now, let me make crystal clear why a bond market on the other side of the planet reaches directly into your financial life. Because these wires are real and most people have no idea they are connected to them at all. The first wire runs through what is called the carry trade, one of the largest and least understood money flows on Earth. For decades, because Japan's interest rates were pinned near zero, global investors borrowed money cheaply in Japan and invested it everywhere else in the world that paid more, especially in American stocks and American bonds. Trillions of dollars in all its hidden forms flowed out of cheap Japanese money and into assets around the globe, including a great deal of it into the American market that holds your retirement. That entire structure depends on Japanese rates staying low. As Japanese yields climb toward 3%, that math starts to break. Suddenly, there is less reason to borrow in Japan and ship the money abroad, and a growing reason to bring it home to capture those rising Japanese yields directly. If that money comes home in a rush, it means selling American stocks and American bonds to do it, and that selling lands directly on the assets in your retirement account. The second wire runs through your mortgage. Japan is one of the largest foreign owners of American government debt, holding well over $1 trillion of it, built up across all those years of shipping cheap money into American bonds. As Japanese yields rise and Japanese investors find they can finally earn a decent return at home, the incentive grows to sell some of those American bonds and repatriate the money. We are already seeing it begin with Japanese investors selling tens of billions of dollars of American debt in recent quarters. And when a giant holder sells American bonds, their prices fall and their yields rise, and American mortgage rates are tied directly to those yields. So the interest rate you pay to buy a home is quietly linked to what is happening in the Japanese bond market, because the same rising Japanese yields that pull money home are the ones that could push your mortgage rate up. There is a deeper version of this problem hiding inside Japan itself, and it is one of the quietest but most important threads in the entire story. For decades, the reliable buyers of Japanese government bonds were domestic. The enormous Japanese pension funds, the life insurers, the banks, and above all, the central bank itself. That is what allowed Japan to run up the largest debt in the world without a crisis, because it largely owed the money to itself, to patient domestic institutions that would never dump their holdings. But that reliable base of domestic buyers is now thinning. The central bank is stepping back. Japanese insurers have been sitting on enormous losses on the bonds they already hold as prices fell, and now the government is increasingly dependent on foreign investors, the fast money to buy its debt. This is a profound and dangerous shift because a government that once financed itself with loyal domestic savers is coming to rely on flighty foreign capital that will flee the moment the trade turns. The foundation under Japan's debt is quietly being swapped from steady concrete to shifting sand, right as the load on it grows heavier. The third wire is the most sudden and violent, and we have already seen a live preview of it. A little over a year ago, when Japan made one modest interest rate increase, a small corner of the carry trade unwound, and it was enough to convulse markets around the entire world in a matter of days. Japan's own stock market suffered one of its worst single days in decades. American stocks tumbled sharply that week. The market's fear gauge spiked to levels seen only in genuine crises, and millions of ordinary people watched their retirement balances drop, most of them with no idea that the trigger was a small rate move in a country thousands of miles away. That was the carry trade merely coughing. The pile of money built on cheap Japanese rates is even larger now than it was then, and the rising yields are exactly the pressure that could force it to unwind again, this time potentially far harder. What made that episode so instructive was how little it took to set off so much. It was not a war, or a bankruptcy, or a crash in the real economy. It was a small move in Japanese interest rates combined with a piece of weak economic data, and that alone was enough to erase trillions of dollars of value across global markets in a handful of trading days before the central bank stepped in to calm things. If a spark that small could ignite a fire that large, imagine what a genuine, sustained rise in Japanese yields, with the fast money now even more crowded into the trade, could do. The preview was a warning written in the clearest possible terms, and the conditions that produced it have not eased in the year since. If anything, they have intensified with every passing month. Now, let me add the other half of this story, because there is a remarkable force transforming Japan's economy at the exact same moment, and it ties this whole saga directly to the biggest boom in the world. The same artificial intelligence wave that has turned American chip companies into the most valuable businesses in history is now supercharging Japan. Japan's exports surged more than 23% in a single year in July, the largest annual increase in nearly 3 years. And the engine behind that surge was electronics and semiconductors, which soared nearly 50%, driven by the global stampede to build AI data centers. Japan makes many of the specialized components, the materials, the machines, and the chips that the AI build-out cannot happen without. So the same global spending frenzy that is inflating your retirement account through American technology stocks is now pouring money into Japan's factories as well. The AI boom has become a global tide, and it is lifting Japan's export economy powerfully. This is the same story playing out on the other side of the ocean, where a single American chip company recently guided to more than $100 billion in a single quarter, the fastest growth of any giant in history, all of it powered by this identical spending wave. The money the world is pouring into artificial intelligence does not stop at the American border. It flows out to every company that supplies a piece of the puzzle, and Japan supplies many of the most critical pieces: the precision machines that etch the chips, the specialized chemicals and materials, the memory and components without which the American giants could not build a thing. So when you see an American chip company post historic numbers, understand that a wave of that same money is landing in Japanese factories at the same moment, showing up as this extraordinary export surge. The AI boom is not one country's story. It is a single global river of capital, and it is feeding the Japanese export economy and the American stock market from the same source, which means a slowdown in that boom would be felt in both places at once. But look closely at why those exports are surging, because there is a dark thread woven through the good news. A large part of the reason Japanese exports have become so competitive is that the Japanese yen has collapsed to a 40-year low against the American dollar, averaging around 162 per dollar, and at times sliding past 163, weakening more than 10% in a single year. A weak currency makes a country's exports cheaper and more attractive on the world market, which is helping fuel the export boom. But that same weak yen is the very thing driving the inflation that is forcing Japan's central bank to raise rates, which is what is pushing bond yields up, which is what is crushing the government's finances and baiting the dangerous trade. So the AI export boom and the bond market crisis are not two separate stories, they are branches of the same tree. The weak yen that is powering the exports is the weak yen that is detonating the bond market. Japan is being lifted and strained by the very same force at the very same time, and there is a human cost underneath the export triumph that rarely makes the headlines. For 30 years, Japanese households lived in a world of falling or flat prices, where the yen in your pocket held its value and even gained it over time. That world is gone. The same weak currency fueling the export boom has made everything Japan imports more expensive, and Japan imports nearly all of its energy and a large share of its food. So ordinary Japanese families are watching the cost of filling a car, heating a home, and buying groceries climb relentlessly while their wages struggle to keep pace. The export machine is booming, but the family budget is shrinking, and this gap between a triumphant corporate story and a squeezed household reality is exactly the kind of tension that eventually forces a central bank's hand, pushing it to raise rates to protect its citizens' purchasing power even at the risk of straining the government's finances. The people are demanding relief from inflation, and the only tool that provides it is the same tool that tightens the noose on the debt. Let me place this in historical context, because a bond market that had been artificially suppressed for years, suddenly normalizing and drawing in yield-hungry money right as the government strains under its debt, has echoes across financial history, and the lessons are sharp. Go back to 1994, a year that still gives bond investors nightmares, when the American Central Bank began raising interest rates faster than the market expected. Bond prices around the world collapsed as yields shot up, and the losses rippled through every corner of the financial system, bankrupting a wealthy California county and blowing up funds that had bet on rates staying low. The lesson was that when a long period of low stable rates suddenly reverses, the losses in the bond market are violent, and they spread to places nobody expected because so many had built their strategies on the assumption that the calm would last forever. Japan has had 30 years of that calm, far longer than anyone in 1994, which means the strategies built on it are deeper and the unwinding could be more severe. Consider also the crowded trades that have blown up again and again across financial history, from the failure of a giant hedge fund in 1998 to the events of 2007 and 2008. Each time, the pattern was the same. A trade looked like easy money, so everyone piled into it, borrowing to amplify their bets, until the crowd was enormous and all standing on the same side. Then something shifted, everyone tried to exit at once, and because they were all on the same side, there was no one left to sell to, and the unwinding was catastrophic and self-reinforcing. The Japanese carry trade, now being fed by this rush of yield-hungry foreign money, has exactly the shape of those past disasters, a crowded, leveraged, one-sided bet built on the assumption that Japanese rates would stay manageable. Reach back to the British currency crisis of 1992, when a government tried to hold its financial position against the overwhelming force of the global markets and lost in a single day, its defenses shattered by speculators who saw that the fundamentals could not hold. The lesson there was that when the underlying math turns against a government, no official defense can hold the line forever against a determined global market. Japan is now testing that same brutal law with its bond market and its currency at once, trying to manage an orderly normalization while the fundamentals of its debt grow heavier by the day. There is one more historical warning that comes from Japan's own past, and it is the most directly relevant of all. Back in 2003, Japanese bond yields, after a long period of calm, suddenly spiked in a matter of weeks as banks that had all made the same bet were forced to sell at once when the trade turned against them. What made it so violent was precisely that everyone had been on the same side, using the same risk models, so when those models flashed danger, they all rushed for the exit together. Yields tripled in a short span, inflicting heavy losses in an episode that became a textbook example of how a crowded, one-sided bond trade unwinds. Japan has seen this movie before in its own market, and the setup today with foreign fast money now crowded into the same trade rhymes with that history in a way that should give everyone pause. The pattern across all of these episodes is the same, and it is the pattern beneath Japan's bond market today. When a long era of artificial calm ends and rates begin to normalize, the money that rushes in to capture the new yields is often the very money that makes the unwinding more violent, because it is fast, crowded, and quick to flee. The calm of the past 30 years in Japan was the deepest and most artificial of any major economy in the world, which is exactly why its ending carries such enormous risk. You might reasonably ask why this matters now, when Japan's debt has been enormous for decades and warnings about it have come and gone many times without the feared collapse ever arriving. For years, betting against Japanese bonds was such a reliable way to lose money that traders gave it a grim nickname, calling it the Widowmaker. Because Japan defied gravity for so long that anyone wagering the situation would finally break was crushed again and again. So why is this time different? The answer is that for all those years, the central bank was standing under the market with unlimited buying power, holding it up by force, which meant no bet against it could ever win. That backstop is now being removed. For the first time in a generation, the market is being left to find its own level, without the guaranteed buyer that made every past warning harmless. The Widowmaker was a losing trade precisely because the central bank refused to let it work. Now, the central bank is stepping aside, and the very thing that made betting against Japan foolish for 30 years is disappearing. That does not guarantee a crisis. But it does mean that the reasons Japan survived every past scare are the exact reasons that no longer fully apply, and anyone who assumes the calm will continue simply because it always has is ignoring the single biggest change in 30 years. Now follow the money to see who wins and who loses. On the winning side so far are the foreign investors who bought Japanese bonds early in this move and are collecting yields unavailable for a generation, and the Japanese exporters riding the weak yen and the AI boom to record sales. On the losing side sit the holders of older Japanese bonds who have watched their prices fall as yields rose, the Japanese government strangled by its climbing debt costs, and Japanese households whose weak currency has eroded their purchasing power and driven up the cost of everything they import. And standing in the middle, exposed to all of it whether they know it or not, are ordinary Americans, whose retirement accounts ride on the stability of the carry trade, and whose mortgage rates ride on whether Japan keeps or dumps its American bonds. The fast money rushing into Japan right now is making a bet that it can capture the yield and get out before the trap springs. History suggests that most of the crowd never makes it out in time, and there is a cruel asymmetry in who bears the loss when it does spring. The large, sophisticated funds that led this trade have the speed, the tools, and the information to move first, and some of them will get out cleanly. The losers are almost always the ones who arrive last and move slowest. The smaller investors and the ordinary savers whose money sits in funds that cannot pivot in an instant. And above all, the millions of Americans who never even knew they were exposed, whose retirement accounts absorb whatever the carry trade delivers. In every one of these unwindings across history, the wealth does not vanish. It transfers from the slow and the unaware to the fast and the informed, and the slowest and least aware participants of all are usually the households who had no idea their savings were connected to a trade happening on the other side of the world. Two scenarios frame what happens next. In the first, Japan manages the impossible balancing act. Its central bank raises rates slowly and carefully. Yields rise gradually rather than violently. The government manages its debt costs. The carry trade unwinds in slow motion that global markets can absorb. And the foreign money that rushed in is rewarded with steady yields rather than a crash. In this world, Japan completes a difficult but orderly return to normal after 30 years, and the trap never springs. This is the hopeful path, and it requires a precision and a calm that are extraordinarily hard to sustain when trillions of dollars and 30 years of pressure are involved. In the second scenario, the balancing act fails. Yields rise faster than the government can bear. Fear about Japan's ability to fund its debt spreads. The crowded carry trade begins to unwind, and because everyone is on the same side, the exit becomes a stampede. The yen and the bond market convulse. The shockwave crosses the Pacific. American stocks drop sharply as the carry trade unwinds into them, and mortgage rates jump as Japanese money floods home. In this path, the preview we saw a year ago becomes the main event, and the retirement accounts of people who never knew Japan had a bond market absorb the blow. Nobody knows which path unfolds, and that uncertainty is precisely why this obscure corner of global finance deserves your attention right now. What we know for certain is that a bond nobody wanted for 30 years has suddenly become one of the most sought after and most dangerous assets in the world, that the money rushing to buy it is the very money most likely to make its unwinding violent, that the rising yields drawing that money in are strangling the most indebted government on earth, and that every one of these wires runs, in the end, back to the American market where your future is invested. If you want to follow this story with clear eyes rather than anxiously, there are a few concrete signals worth watching in the months ahead. The first is the level of the 10-year Japanese yield itself, because the further and faster it climbs past 3%, the more strain lands on the government and the more the carry trade is pressured to unwind. The second is what the central bank does at its coming meetings, because a rate hike, especially a larger or faster one than expected, is the exact kind of spark that set off the global tremor a year ago. The third is the yen, because a sudden sharp move in the currency in either direction is often the visible sign that the carry trade is beginning to move underneath the surface. And the fourth is any sign of stress in the American market on days when Japanese yields jump, because that connection appearing in real time would be the early evidence that the wire between Tokyo and your retirement account is live and carrying current. Those four signals are the dashboard, the record inflows, and the 30-year high yield are the flashing light that told us to start reading it. There is an old saying in finance that fits Japan's moment better than any statistic. It is that the market can climb the stairs on the way up, but it takes the elevator on the way down. For 30 years, Japan's transformation has been climbing the stairs, slow, patient, gradual, a bond market inching back to life 1 basis point at a time, a trap baiting itself so quietly that the money rushing in barely notices the danger. But traps like this one do not spring slowly. When the crowded trade finally turns, when the fast money all reaches for the same narrow exit at the same moment, the descent will not take the stairs. And every American with a retirement account and a mortgage is standing in the same building. Most of them with no idea that the quiet, boring 30-year bond market of a country across the ocean has become one of the largest hidden risks to their own financial future. This, as always, is not financial advice, But please understand that when a financial asset goes from unwanted to irresistible this quickly, the very stampede of money that makes it look attractive is often the thing that makes it dangerous. Please understand that the rising yields drawing the world into Japanese bonds are the same yields crushing the most indebted government on earth, and that these two facts cannot coexist peacefully forever. Please understand that a crowded carry trade built on 30 years of cheap Japanese money flowing into American markets sits underneath your retirement account whether you ever chose it or not, and that history says the exit from a trade this crowded is never gentle. And please understand that the same artificial intelligence boom lifting Japan's exports and your retirement account is tangled up in the weak currency that is straining Japan's bond market, so that the forces lifting you and the forces threatening you are, in this strange moment, one and the same. The bond nobody wanted for 30 long years has become the asset everybody suddenly does, and that reversal, quiet and slow and easy to ignore as it seems, may prove to be one of the most consequential financial stories of our time, precisely because so few people are watching it happen. The most dangerous risks are rarely the ones on the front page. They are the ones building quietly in a corner of the market that nobody thinks to look at, until the day everybody has to.